Hello, so I thought I'd just do a really quick video to give you some top tips for paper 2. I've just been having a look at what's been questioned before and what hasn't. So this is by no means a guarantee, but might give you just a way of prioritising your revision. So the little sticky notes that you can see here in green are things that I think you should focus your revision on. These are things that haven't been particularly well tested yet. Obviously, some of these sources of finance have. Just to make you aware, so the yellow ones here, they're yellow because they are short-term sources of finance. And we haven't had really any questions on trade credit or overdrafts before. Sale of assets came up on last year's paper, so I think it's unlikely that that's going to come up again. Owner's capital we haven't had for a while, nothing on retained profit. There was a question about a loan in 2020 in comparison to crowdfunding. So again, nothing to say it won't come up, but it has been tested before. Nothing on share issues, and last year there was also a question that asked about new partners. So make sure that you are happy with both of, all of these that haven't been tested. So trade credit is, like I said, it's short term. Both of these are short term. And they are ideally a way to sort out when you've got a cash deficit. So if you can see that you're not going to be able to make all the payments that you need to make in a month. So this is also linked to cash flow. So if you've got a cash flow problem, so your cash outflows are larger than your cash inflows, one of the things that you can do is try and get some trade credit from your suppliers, where they let you have your raw materials or your stock, and then you don't pay them until maybe 30 days later. So it gives you a chance to make your sales so that you can pay that supplier because you've had a chance to generate the revenue to be able to make that payment. And obviously an overdraft is for your bank account, where you're allowed to overspend on your bank account. The daily interest, so it's charged daily, is quite high, but for short-term purposes this can often work out cheaper in total than taking out a loan, which will obviously be for a much longer period of time. But just to give you a comparison, overdrafts are normally around 40% interest, so we definitely don't want to use them for a long period of time, whereas a loan at the moment is about 9% interest. So overdrafts are really good in the short term to give you that flexibility. You don't have to go to the bank. As long as you've got an overdraft arranged, you can just use that overdraft, and then as the money comes back in, you come back into credit in your bank account, and then maybe towards the end of the month when money's running out, you can just go back into debt effectively because you're overdrawn, you've gone over the amount of money that's in your account. Sale of assets I'm not going to talk too much about. Owner's capital, there was a question, you had that in your mock before, should they use their own capital? Really, again, the benefit of this is that there is no repayment, but the downside is that it's that opportunity cost. Once it's gone, it's gone. Same for retained profit. So one is owner's capital, that's if you're a sole trader. Retained profit is going to be owned by the business. So if you're a limited company, then you will have retained profit if you have made profit in previous years. Retained profit, no guarantee. Sometimes if a company has retained profit, they'll have needed to have made a profit in a previous year, and effectively this is just the equivalent of having cash, a cash surplus that hasn't been spent. And we want to make sure it's not too high, because we want any cash that's sitting around to get the balance right. So we want enough to be able to manage our day-to-day expenses. But if we've got a lot of cash, we want to be looking at how we can make that work more effectively for us, so some sort of investment. Share issues, obviously you can issue shares if you are a PLC to the public, and if you're an LTD to private individuals. This is a good way of a cash injection. And again, there is no repayments, but what you are doing is, if you're a PLC, potentially opening yourself up to a hostile takeover, and also increasing the number of owners in a business. So, potential for disagreements between what might happen with the business, and more dividend payments to make to your shareholders. With quality is on the advanced information but hasn't been tested previously. Remember, there are two forms of quality. We've got quality control and quality assurance. So you want to make sure that you know the difference between them. Sorry, I don't know what's going on here, so let me just rub that out. Quality control is when we wait till the end of the production process. So it's at the end of the process, and it is checking staff against standards. And so we're still restricting the number of defective products that might get to a customer, but it's at the end. And so that can be problematic because that can end up with huge amounts of wastage. It can be quite costly. Quality control, quality assurance, sorry, on the other hand, is where we make sure that our quality is built into every aspect of production. Every member of staff is responsible, and it's built in all the way through from when we take on the delivery of our raw materials all the way through to the end, so built in to the production process. So this can take a bit more time. It can slow the production process down, and we also need to make sure that all of our employees are adequately trained so they know what to look for in terms of quality. But it should mean that at the end, when we still do quality control against certain standards, that all of our products are going to meet those standards, and there won't be any wastage, which obviously then would link in to sustainability as well. So sustainability, one of the ways in which we can be more sustainable is to minimise the amount of waste. Obviously much more cost effective for the business as well. So although they might need to invest in training their employees, if they're having much less waste, far fewer customer complaints and returns, that's going to reduce their costs associated with that. So in terms of calculations, a gross profit is the only one that I can see that has not been assessed in recent times. Net profit was on the paper last year. Net profit margin and gross profit margin were on the paper the year before, and ARR the year before that. So gross profit, remember, is going to be revenue, take away the cost of sales. And what you're looking for there, so if they give you cost of sales, great. But if you have to calculate it, you're looking for anything that says per unit. Okay, so if you think back to the cushion question that we had recently, it was the cushion filling, the cushion cover, and then it said wages per cushion. So anything that is individualized to each element, remember a variable cost of sales is things that vary with output. So the more you make, the more it's going to cost. And so if you have to add them all up, then remember you've also got to times them by the number that they were that was sold. So per unit added together times the quantity sold. So the example we had was, they'd sold 250 cushions. So you'd have to make sure that your cost of sales is either the total, so it'd say total cost of sales, or if you're having to work it out, you're looking at the quantity sold and then all the individual elements of the cost as well. So if it talks about anything that you can do to improve the gross profit, the only things that you're going to be able to talk about are either increasing your revenue, so you could think about putting up your prices, or reducing the cost of raw materials, and obviously you want to put that into context of whatever the business is doing, raw materials, packaging, and any wages. So we don't want to be saying just, reduce people's wages, but perhaps, if we can, reduce the total number of hours that somebody is working, rather than saying, right, you've got to take a pay cut. ARR is the way that we can look at competing projects. So this is a way of looking at investment. So this might be where a company has got quite a bit of retained profit and they're not quite sure what to do with it. And this is a form of what we call investment appraisal. And it is a way of looking to see which project is going to generate the greatest return on our investment. So let's imagine that we want to buy a new piece of equipment and that piece of equipment costs us £100,000, okay? And over 3 years, they are predicting that we might get a total profit of 175,000. You might get that in 3 separate years. It might say year 1, 25,000, year 2, 100,000, year 3, 50,000. So it's still going to add up to 175,000. So the number of years is important. So the first thing that we have to do is take away the cost of investment from the profit. So 175, take away the cost of investment, which is 100, okay, which leaves us obviously with 75,000. And that is over 3 years. So we're going to divide that by 3 years. So the average annual profit is 25,000. what we would do with that 25,000 is then divide it by the original investment cost. So that was 100,000, which is 0.25, and then ARR should always be a percentage. So if you get this question in the multiple choice, anything that's not a percentage can't be the correct answer for ARR. So this is going to be 25%. Okay, return. And what that means is that for every £100 that has been invested, the project's going to yield a yearly profit of £25. So the higher this value, the better the return on investment. We could also compare that to leaving that retained profit in the bank. Retained profit in the bank is, not a very good option at the moment because interest rates are really low. So if we left it in the bank, we might get maybe 1% interest. So it's much better to invest it in a project, but remember this is a proposal. It's a prediction. So there's no guarantee that we're going to get £175,000 over those 3 years. So if it's not as profitable as you've planned it to be, that can obviously be a problem. But it's a good way of being able to distinguish between competing projects. And like I say, always look out to see which is the highest value. And then you would say, it's a measure of profitability. So the higher the result, the better. The last one to look at that comes up time and time again is globalization. And that's because the exam board are not particularly happy with previous student responses to these types of questions. So it's more than just, selling to more countries. Okay, it's about interconnectedness of different countries, different businesses in different countries and with different people. So it's looking at that interconnectedness of economies, governments, businesses and people. One of the big pluses of globalization is obviously that it does open up international trade. So I'm going to just pop these on as sticky notes now. So let's pop those on. So one of the big benefits is international trade. International trade. So they're getting to operate in markets that they haven't operated in before. We can also make sure that we are spreading some of our risk. So if something doesn't work particularly well in one country, that might be offset by something being really well received in another country. So it helps to spread the risk of a particular product. And also we can increase, hopefully, our sales and profits because we're operating in a wider marketplace, increase sales and profits, because we've just got access to more customers because we're now operating internationally. So help can build an international brand as well, so more global recognition, spreading the risk, increased sales and profits, access to more customers in more locations. But the downsides is that we can now have problems with our supply chain because the supply chain is now going to be bigger and more complex. So supply chain issues, especially if we're not actually located in all of the countries in which we're operating in. So we might stay in the UK, for example, but now be operating in lots of other different countries. And so getting our products to those countries can be more problematic. We might also need to spend quite a lot of money on our promotion because, sorry, not just promotion, but just marketing, because we might need to tailor our products and our promotion and our pricing depending on the culture and the wants and needs of that country that we're now selling to. And also what we have to remember is the UK is actually quite an expensive country in terms of manufacture. And so if we're competing on price, that might not be a good thing because we're going to probably come out as being quite expensive in comparison to other countries. So the other thing as well is that we've obviously got much more increased competition, because we're not just competing with our domestic competitors, we're now also competing with any other manufacturer in those other countries. So I'm almost up to my time, 15 minutes. So I hope that's given you an overview of some things to focus on. Obviously, it's not the only thing, but things that I've picked up for this paper.